Hi, it's Ty. I'm here in my garden here in Portland, Oregon. It's been a nice April day. Hopefully you'll be able to hear me over the birds that are out here. The greenhouse is full, so I had to stop working because I have no room to transplant anymore in the greenhouse, and I'm just right on the verge before I really want to take everything out of the greenhouse. So yeah, time for me to end for the day, and good time for me to do a video. And I wanted to do a video on a case that's on my mind, alternative health. This was a cannabis case from back in December, and I was actually pointed to this case by a lawyer, a colleague of mine, who wrote an article about it, and I'll put his name and a link to his article about it in the description below, because I think I think this is an important case, the alternative health case, and worthwhile getting as much different information as you can about it. And my video, I'm going to talk about some of my observations from reading the case directly, so I'm not just regurgitating what my colleague wrote here in a video. But this is probably one of the only cases where I feel a little bit uneasy or disturbed by the court's result. I mean, most of the other cannabis cases that I've seen, I didn't find the results all that disturbing because I guess they fit in my worldview of how things work in taxation. But this one came up with a result that, as I'll talk about, that is not the way I would think something should work, and doesn't seem at all right or fair or logical to me. So I'll talk a little bit more about that. In the alternative health case, a lot of these cannabis court cases that we're seeing that came up last year with regard to California are related to medical dispensaries, because it takes years for these cases to come out, usually, because it takes several years before the IRS actually gets in deep with an audit, and then it takes time after that before the taxpayer is suing the IRS in tax court or some other court to try to get a better result than they got from the IRS. So we're talking about tax years, like in the alternative med case, we're talking about tax years of 2010 through 2013. And so one of the things that I've seen come up several times in these California medical marijuana cases is, as is the case, alternative health is a dispensary. And so kind of two themes that I've seen tested a few different times. The theme that's often tested, of course, is the CHAMPS standard, which is this idea that you can allocate costs between your 280E and your non-280E activity. So let me speak to that point first. And the court, the IRS didn't think there really was a legitimate separate activity to allocate costs to in the case of alternatives medical dispensary, and the court took up that question, ultimately agreed that there wasn't. And so when looking at that question, is there a separate non-280E activity that you could allocate costs to, this is a common strategy that we see with dispensaries via the CHAMPS case, and there's been lots of subsequent cases that have basically put limits on how far you can take CHAMPS. And one of the things that I've advised the community before, dispensaries in the community before, is that, well, you really have to have a separate activity for profit that on its own would have a profit motive if it weren't for the dispensary. And that's often not the case. It's often that this so-called separate activity is just like selling some kind of paraphernalia or branded material or whatever that is just totally ancillary to the marijuana business, the sale of marijuana. And if it weren't for the sale of marijuana, there's no way the operators would be selling that other stuff, right? And that was mainly from my own intuition that I would say that. And really, because what CHAMPS really got at was, well, in the CHAMPS case, there was clearly other activities that were carried on with their own economics and their own profits, separate from the sale of marijuana. And so, at what level does something become separate, right? Well, in this particular case, this whole thing was tested again, and one of the court, basically what they looked at and what they said is, well, for something to be a separate business from the marijuana business, for it to be a separate business, they use this standard that the taxpayer must be involved in the activity with continuity and regularity, and the taxpayer's primary purpose for engaging the activity must be income for profit. And that statement came out of another court case, but the point of that statement is about whatever the non-280E activity is, right? So that I think that's kind of saying the same thing that I've been saying to clients and to the community, is that, look, you've got to, this has to be when you pair a marijuana business with something else so that you can allocate costs, the something else has to be a business in its own right. It can't just be some tiddly or some something that you would never operate on its own, just made up for this purpose, because the IRS will see through that, and that's what we keep seeing in these court cases, that's not being allowed. What the court concluded in this particular case was that just by looking at how little floor space and how little the employee activities were in compared, when they made a comparison of the sale of marijuana to the sale of the other items that this particular dispensary was selling, the paraphernalia and various things this other dispensary was selling, they just made a comparison of floor space and employee activity, and they just said, well, it's clear that Alternative's primary business was selling marijuana, and anything else was just incident to. And the court said that's not good enough. That if the other item, even if it could be a business, even if you can show, I think what's interesting about this is, even if you can show that it could be profitable, the fact that it's only being run incident to a primary business, which is selling marijuana, makes it not count. You can't count it as a secondary business to allocate costs to. That was the court's conclusion here. So they're really narrowing in. The courts continue to really narrow in on the idea that was put forth in Champs, that you can have multiple lines of business to allocate costs to. But again, I would say that what I've been advising before is still true. Like, if you have a legitimate for-profit activity, and I know many entrepreneurs who get into the cannabis space where this is true, because they're not just cannabis entrepreneurs, they often are entrepreneurs who have other businesses. And so in those contexts, if there's a reasonable way that you can bring them together to allocate costs, I still think that should work. I don't think these cases close the door on that possibility. Now, the part of the case that was particularly troubling to me, that I don't like the answer on, is how they dealt with the management company that was in the corporate structure in this case. So in this case, you had Alternative, which was a C corporation that was running the dispensary, and then they had this separate S corporation owned by some of the same people called Wellness, and that S corporation was a management company, and the management company would then have employees that worked in the business for Alternative, and they would incur costs, and they would charge a management fee or a consulting fee to Alternative. So I've seen these things where they don't work well because the management companies are not charging appropriate fees, in my view. In other words, what was always clear to me from the beginning of seeing these kind of structures was that if you started up a management company and the only thing that management company served was another cannabis operating company, that management company better be charging a fee that covers all of its costs to the cannabis company plus some profit margin. And we call that cost plus transfer pricing. Section 42 lays out transfer pricing guidelines, and from my perspective, I've seen that missing in a lot of the cannabis structure that I've seen. They've set up these multi-entity structures with management companies, and then they just kind of forgot to get the fee right in there. And looking at the numbers that were in this case, I would say this was true too here, because they did charge a management fee, and the total management fee was more in I think all but one of the years that they were auditing. The management fee was more than the total expenses, but the margin was very, very small. Unbelievably small. They weren't showing much profit, and to me, that's not an appropriate intercompany pricing between the entities. So I would have, if I were in the IRS position or the tax court, I would have dinged the taxpayer on that issue, on the fact that they didn't have robust or complete enough transfer pricing, and they didn't seem to be pricing it at an arm's length standard. Now, those of you in the cannabis community or cannabis operators may say, "Oh, Ty, quit giving the IRS ideas. That's terrible." No, because what I'm saying is actually better than what the court actually did. Okay, so what I'm saying is, look, as long as there's appropriate transfer pricing, the two different entities should be respected, and the management company itself shouldn't really be a 280E company. And it shouldn't really matter, because if the management company is properly charging the right price to the operating company, then the value of those services, the cost of those services, are being appropriately disallowed under 280E in the operating company. And I think that should be the right answer. But the IRS and the court totally skipped over this point. They totally ignored this. They didn't address the inappropriate amount of the transfer price or the management fee itself. They totally blew past that, and they did something more extreme. What they did is they said, well, we believe that Wellness, the management company, is a separate company, so you set it up to look like a separate company, and we're going to give you that. We're going to say it's a separate company. But as a separate company, we believe that it's also trafficking in cannabis the same as the operating company is trafficking in cannabis. And so we're going to apply 280E to both companies. But because you set them up as a separate company, we're going to apply it to both companies separately. Now this is crazy, because now what happens is this is a worse result than what I've been thinking should happen, right? Because what this means is that in this case, the C corporation had a management fee, which much of which was for overhead salaries, sales, distribution type stuff, right? That management fee, parts of it, a lot of it, would be disallowed under 280E. Then on top of that, now they're saying that Wellness, the management company, is also a company subject to 280E. So the fee that was paid that was not deductible under 280E, that fee not deductible under 280E, and these fees were like $900,000, $1 million in some years. They were kind of ranging anywhere from $900,000 to $1 million, depending on the tax year that they were in, right? These fees that were non-deductible under 280E when paid by Alternative, the cannabis operating company, to the management company, Wellness, are revenue to Wellness, and they're taxable. But because now the IRS is saying that Wellness is also subject to 280E, 280E couldn't deduct any, or Wellness could not deduct any of its expenses under 280E. Couldn't deduct the CEO's salary and all the various salaries that were under there, because they were saying Wellness was in the business of trafficking cannabis the same as the company it's serving, Alternative. And basically what that did is it took what their non-deductible 280E expense was and doubled it. It doubled the tax burden on them by that separate transaction. And the taxpayer argued that exact issue. They said, look, applying Section 280 to both Alternative and Wellness is inequitable, because deductions for the same activities are being disallowed twice by doing that. And yeah, I totally agree with them. It is totally inequitable. What should happen is, to me, it seems like the two results that should happen here is either one, the IRS should enforce appropriate transfer pricing at arm's length rates, which will mitigate any kind of result that's disadvantage to the government in that way, or at best they should look at the entities and collapse them together and say these aren't really being operated as separate entities, because this is what I was always afraid of. I was always afraid in these structures the IRS would come in and just say, look, they're not really separate entities, you're just trying to play a game here with the taxes, so we're going to collapse them together, we're going to ignore the intercompany transactions, and that's that. And if there's some tax if there's some kind of marginal amount of tax that was not paid on this, you'll get slapped with some penalties. I thought, that would be the worst case scenario, but that wasn't the worst case scenario. The alternative health case is the worst case scenario. It's the IRS saying, hey, you set them up as separate, so we're going to keep it that way, but then we're just going to allow the costs on both companies, creating double the tax that the company would have had they just run all of this as one entity. It's a terrible, terrible result. And basically, the court's answer to this whole, when the taxpayer said, hey, we're going to get hit twice with this if you apply it to both companies, the court's answer was, these tax consequences are the direct result of the organizational structure that you as taxpayers employed, and you haven't come up with any legal basis for remedying this problem, so too bad, you're stuck with it, right? So this is a terrible result. It's something for us all in the community that are working in this community in the cannabis industry to start looking at these structures and see if it can be unwound or if we have other factors that might mitigate it. But it is really unfortunate. And like I said, if you've kind of caught what I've said, I think a lot of cannabis companies that I've seen weren't doing their intercompany pricing right, but what the IRS is doing is a step too far. This is not logical. It doesn't make sense. It's not fair. It just seems purely punitive, and I hope that this somehow gets reversed. This was tax court, so it could get appealed. The decision could get reversed. I hope that it does, because it's not a reasonable result in this case. I think that we need to be looking for reasonable, fair answers. I believe 280E is the law, so I don't think we just let cannabis companies off the hook for 280E, but we should be looking for reasonable ways to operate it, and this just doesn't seem like a reasonable way to operate 280E. Okay, so another thing that came up in this case, which has come up in many of the cases in 2018, once again the courts reaffirmed that the taxpayer cannot use Section 263A to capitalize more costs to inventory. They repeated what is now known as kind of the standard thought about this law, that 263A was not designed to create deductible costs out of things that were otherwise non-deductible. It was designed to characterize costs that were already deductible. So you can't take a cost that is not deductible in 280E and capitalize it to inventory by virtue of 263A. The IRS told us that back in 2015 with their chief counsel advice, and the courts in the courts ever since, and really in 2018 there were at least 2, maybe 3 cases that I saw that affirmed this standard. So this is pretty solid and well-known law. If you're out there in the cannabis world applying 263A, you're all wet. The IRS has said no, and the courts have said no, you can't do that. Another thing that's come up a lot in the 2018 cases that I've seen, or at least a few cases that I've seen with these California operators, because they're operating in the medical space, is a question of whether they are actually a producer or a retailer. And the issue there is, and I may have talked about this in another video, but the issue there is that there's different capitalization standards under the Section 471 regs, which is what you should be using. Rather than 263A, you should be using Section 471, which is what the IRS told us to use, and is what the courts have agreed is the appropriate code sections and treasury regulations to be using for determining your cost of goods sold, is the Section 471 regs. And in there there's a difference between whether you're considered a reseller or whether you're considered a producer. And a producer, of course, by virtue of the fact that they are using facilities and costs to build inventory, have a broader set of costs that they can capitalize and treat as inventoriable and deductible costs than a reseller would. So dispensaries who are pure resellers really they get the worst end of this, right? A producer who gets to use producer regulations gets to conclude more costs or consider more costs to be inventoriable costs. So I haven't worked a lot at all, actually, that I can think of. I don't think I've worked at all with a medical dispensary. By the time I got working into the cannabis community in earnest, we had already gone recreational in Oregon, and so and so this is kind of it's an academic thing to me to see. Some of you have worked with this in practice, so you probably relate to this and understand this better. But essentially, what's happening, or what's been happening in California, is that the dispensary, the medical dispensary, will be working with their client patients, right? So they will, in some cases, they will give their client patients the marijuana plants, and the client patients grow those marijuana plants, and then they bring them back, and then the dispensary puts them through some sort of process to create oils and tinctures and flour and things that can be used, right? And then they give it back to the patient at that point. So now, there's a couple of different lines of argument that I've seen a couple of times and that were readdressed here. Is, well, as a medical dispensary, could Alternative actually be a producer because of this whole process? And 2 arguments that have been made more than once now would be, one, when they give the marijuana plant to the patient, is the patient basically acting like a contract manufacturer for the dispensary? So was Alternative really a producer the entire time, and the patients were their contract manufacturers? That's an argument that Alternative is made, that other dispensaries have made. The IRS has said, no, we don't think so. We think you're just a retailer and you can only apply the retail standards, and the courts have agreed, and the courts agreed this time as well. So that that line of thinking has not been allowed to go forward. And any other, and also I think they made an alternative argument for why they were a producer because of the work they did after they got the marijuana plant back from the patient, but that also was not allowed to go forward. So the court, again, in this case, as they have with other cases, foreclosed the opportunity to or shut down the idea that a dispensary could actually claim to be a producer and use producer regulations rather than just the retailer regulations. Something that I thought was interesting that came up that came up in the court case, the court seemed to take particular exception to the fact that Alternative didn't actually state on their tax returns that they were selling marijuana. And, instead they said something like their business activity was something like medicine sales. And they didn't disclose anywhere that they were applying Section 280E. And so I thought that was interesting that they brought that up because I've seen that a lot in the preparation community, that cannabis companies getting their tax returns prepared, their preparers will obscure what the company actually does, and they won't put in the book to tax adjustments that they're adjusting for Section 280E. They'll just say something ambiguous like this is a non-deductible item. So they may in fact be applying the law correctly, but they don't provide transparent labeling, presumably because their clients don't want anyone who looks at their tax return to immediately know that they're in the cannabis industry. In my experience, I've heard this before. My experience with this is not necessarily to try to avoid anything with the IRS. It's to avoid things with other people who might look at your tax returns and not immediately disclose them what industry they're in. So this is something I've seen preparers do, and I took note of it in this court case that the court does not like it. They basically said, you're going to get hit with accuracy related penalties. So, these are gray areas in cannabis law. So they not only said, look, you did it wrong and you're going to have to pay back taxes and interest, but we're going to slap penalties on you for doing it wrong. And the taxpayer was like, well, wait a minute, this has been a gray area. This was, in the years we're talking about, the only case around at the time was the Champs case. You're really slapping us with these penalties just seems like unfair. It's, I think reasonably you could look at this and think that reasonably we did our best to follow the law. There wasn't a lot of advice or information about the laws during this period of time, and I think the taxpayer is right about that. But the court in examining that issue, threw in their face that they hid the fact that they were selling marijuana on their tax returns and that they didn't have plainly a 280E adjustment stated on their tax returns. So I thought that was interesting because in my mind, I don't quite make the connection between the two things anyway, but I thought it was interesting that in applying penalties to the taxpayer, they didn't like it. And I guess one of the reasons I find it interesting is in the tax returns that I've been involved with, we've been clear about that with our clients, that look, you should be clear. You shouldn't be hiding anything. You should be clear about what you're doing in the tax return. The book to tax adjustment should just say 280E right on it. That way there's no, it doesn't look or smell like you're trying to obscure what's going on here at all. And that's the way we've done it, or at least the tax preparers that have worked with our clients that we've been helping advise on have done it, is that everything's very transparent and everything's labeled so that it's obvious what's happening. There's no attempt to hide what industry that particular taxpayer is in. Now, the other piece to the accuracy related penalty, to the fact that the court said that the taxpayer was going to have to pay accuracy related penalties, the other piece to that did make sense to me was that they basically said, look, you didn't seek any advice. You didn't seek any advice for the proper tax treatment for your transactions. You just did it, and there's no evidence. You didn't get any memos or any formal advice from law firms or accountants or anything like that show that you used any kind of expertise to come up with your position. And I think that's pretty rampant in the cannabis community, as people kind of hear what other companies are doing and then they think that gives them enough authority to just do it themselves. And what the court case here is indicating is that had Alternative actually had some more formal advice to their positions, they may have been able to avoid some penalties by showing, hey, we did what a reasonable, prudent business would do. We hired experts in taxation and in these matters to give us guidance and opinions on how to do this. They didn't do that, so the court said, because you didn't do that, that's another reason why it seems appropriate to slap you with these penalties, right? Another nuance to this is Alternative, of course, did have a paid preparer, did have a professional who prepared their returns, but the court draws this distinction. I think it's a distinction that a lot of taxpayers don't understand. They drew a distinction between if you take your financial statements, which already kind of in themselves have a position in them because they've already decided in the financials what is cost of goods sold, what isn't, stuff like that, right? And you just hand it over to your tax preparer and you say, here, prepare the tax return. That's not getting advice from the tax preparer. Just giving them the data that they then churn through a tax return does not then suddenly protect you as if you got qualified advice. There was no evidence that they actually asked that person who prepared and signed their tax returns for advice on the actual tax positions. The court made that distinction, which I think a lot of taxpayers reasonably would miss that, because I think most people think, well, if I hire a professional to sign and prepare and sign my tax return, doesn't that mean that they're telling me what the tax position should be? Well, kind of, but maybe not. I mean, it's not that's basically what the court is saying, is no, it doesn't. Unless they actually did tell you, hey, I've evaluated your tax position, here's what it should be, as well as prepared your return, then the court didn't accept that the taxpayer had actually gotten any professional advice on this. And I think a lot of people, and even for me, that part seems a little bit odd. I think that I can understand why most clients would think that if they have a professional prepare their return, they've also got advice. But I think, my recommendation on that then is, okay, well, make sure you are getting that advice. Make sure that it isn't just they're just preparing the return and signing it the way you tell them to do it by virtue of the financials. You give it to them and they're just churning through it, but that you've actually asked them, what should the tax position be? And you have some record of them telling you what the tax position should be, that they're not, that a later court or IRS doesn't look at it and say, oh, well, the taxpayer just followed the documents you gave them without providing any advice, because that's where they got burned here. All right, well, I've rambled on about this case. It was on my mind ever since, like I said, ever since a colleague pointed it out to me earlier this week. I thought, gee, I needed to read more about it, and then as soon as I read more about it, I was like, gee, I need to put something out about this to the community as well. And maybe many of you were onto this and knew what a shitstorm this is already before I did. I'm sure many of you did, but for those of you who didn't, or those of you who just appreciate hearing a different perspective on it one more time, that's why I do these. So that's it, and I'm gonna call it a day. It's been fun in the garden. It's nice and sunny now on me, and I'm gonna maybe sit down for a little bit, relax, and then head home. Bye now.